When you say, diversify your portfolio, everyone agrees there's a lot of economic science behind it. Of course, diversification is good, it's powerful. What diversification does, if it's done correctly, it should increase your total return without increasing your risk. Meaning, anybody can get a high return at a high risk. You can say, Jim, I want you to manage my money. I can go to a casino, bet it all on red. If I win, I come back and say, hey, Shay, look how much I made. But of course, if it comes up black, you lose everything. So that's a high risk, high reward, and in the long run, not winning proposition. But the question is, can you increase the return without increasing risk, or can you increase the return more than the amount of risk? That's what diversification does for you. But here's the problem. Most people don't really understand diversification. I run into people all the time who go, I'm highly diversified. I've got 50 different stocks in 10 different sectors, technology, consumer non-durables, services, mining, etc. I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they become highly correlated in certain conditions. So yeah, you may have a lot of different stocks, fine. But if the stock market's going down, they all tend to go down together. If it's going up, they all tend to go up together. You're not really diversified if you're in a single asset class. Real diversification means having numerous asset classes that are not highly correlated to each other. So have a slice of stocks, absolutely, by all means. Have some government bonds, for the American investor, a lot of global investors, in fact, 10-year treasury notes, Australian government bonds for the Australian investor, et cetera. Have some land, have some real estate, have some venture, have some so-called alternative assets, hedge funds, if you can get in, they can be hard to get into, et cetera. And natural resources, oil, energy, water, and then some gold and some silver. So that's real diversification, because gold will not correlate to stocks. Sometimes it does, but often they move in opposite directions. Gold correlates to bonds a little bit, but then you've got to throw in inflation, which helps gold and does not help bonds, and so forth. So, by the way, I forgot to mention a significant slug of cash, maybe as much as 30%. And I actually call it the barbell portfolio. So, barbell, you got two heavy ends and a connector, so over here are your deflation hedges, and your deflation hedges would be the bonds, utilities, and then you have your inflation hedges, and they might be a normal stock portfolio, gold, etc. But cash is in the middle. Cash is the thing that connects the two, and cash has a couple interesting properties. But people say, why would you have cash? It has no yield. Well, it has a very low yield. There's no question about that. But in a deflationary environment, you can't rule out deflation. In deflation, cash can be your best performing asset, because the nominal value is pretty much unchanged, but the real value goes up because every dollar is worth more in a deflationary world. The other thing that cash does is the exact opposite of leverage. A lot of the assets I mentioned, I include stocks, bonds, and hedge funds and others, and gold for that matter, they're volatile. They have some volatility. Cash has zero volatility. It's just cash. And so what it does is it reduces the volatility of the overall portfolio. So you can have volatile assets on either end of the barbell, but cash kind of damps that down a little bit. It helps you sleep at night. And then the third thing it does, and this is not very well appreciated, cash gives you optionality, has embedded optionality. So we live in an uncertain world, that's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on? And we don't really know. So what that means is if you place your bets, say, okay, I really want to get into bonds. I think there's a place for bonds. You get into bonds, and all of a sudden here comes inflation. Those bonds are going to do very poorly. If you get into stocks and here comes a recession, the stocks are going to do poorly. So these bets can be good bets, but it can also be a mistake. Or you get into the private equity fund, can do very well, some have, but it's completely illiquid. Don't expect to get your money back early from Henry Kravis. He won't give it to you as you're locked up for 7 years. So the point is, the purpose of cash is, as we get more clarity, as some of these things, Fed policy, central bank policy, inflation, deflation, as we get more clarity on these things, the person with cash has the optionality. You can pivot. If all of a sudden inflation comes in way higher than expected, you can go buy some gold. And if deflation appears, you can buy some bonds. So think of cash as it's kind of an at-the-money call option on every asset class in the world. That sounds like a pretty valuable option. Well, that's what cash gives you. So a big slug of cash in the middle, maybe as much as 30%, just so that you can reduce volatility and be nimble. But real diversification is going to be stocks, bonds, alternatives, venture, hedge, natural resources, cash, gold. They're all going to be in the portfolio, and that will perform well in every state of the world, some will do better than others, but that's the point. That's what diversification gives you. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, from about 600 tons to about 2,400 tons. China, the same, about 600 tons to about just under 2,000 tons that they report, but they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. People's Bank of China is kind of transparent. SAFE is non-transparent. So every 6-7 years, what you'll see is the People's Bank of China will announce, well, we've increased our gold reserves by 400 tons or 500 tons or whatever as the case may be. And well, it's not like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. What it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers in tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. The Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons. What it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, what as the case may be, and they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along. You can't buy that much that fast. So then that begs the question: well, why all of a sudden, when China's making noises about invading Taiwan? Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of violence as far as the Chinese are concerned. And this happened right around the time, maybe shortly after U.S. debacle in Afghanistan, which was the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you'd have to go back to find a worse turn of events. But all of a sudden, allies all over the world, Israel, Japan, Taiwan, are questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here you leave Americans behind enemy lines. Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and they'll have to step up a little bit financially, militarily, etc. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. Put it on the books. So the biggest buyers of gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. Since 2010, central banks in the aggregate have been net buyers. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar if you have US dollar inflation, or to collapse the confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question. What percentage of US reserves are in gold? The answer to China is about 2%. Russia is about 20%. You know what the percentage is for the United States? 75%. The US does not rely on euros and Aussie dollars and Canadian dollars for its reserve position. A little bit. So don't let any central banker, don't let Jay Powell or John Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world, and 75% of our reserves are in gold. So that's the US, as they say, watch what they do.